Good afternoon, everyone. Welcome to this NBB webinar on monetary policy. I'm sure today you will learn a great deal about the ECB's monetary policy over the last 20 years and about the recently concluded monetary policy strategy review. And I think today we are very lucky in at least two respects. And the first reason that we are lucky today is that in the next hour or so, it will be an extremely productive hour because our speaker of today, Roberto will provide us in less than 1 hour with a walkthrough of a book that has more than 400 pages. And this book, I can assure you, it's not a regular book. It's an extremely well-documented and academically grounded insider view on monetary policy since the ECB was set up in 1999. So today you will not just get a presentation on a single academic paper, but a well-documented tour d'horizon of euro area monetary policy from within the euro system, written by key players. And indeed, Roberto didn't write the book alone. He co-authored the book with a number of colleagues who have all been very closely involved with actual monetary policy making over the past 10 to 20 years in the euro system in the ECB. And the second reason is that it's Roberto himself who is joining us and who will present the book. Roberto is an advisor in the monetary policy department of the ECB, and prior to joining the ECB in 2000, he obtained a PhD in economics from the University of York. And I've known Roberto for more than 10 years now, and as an illustration of the relevance of his work, Roberto, together with long-standing co-authors Massimo Rostagno and Larry Cristiano, already developed macroeconomic models with a role for the financial sector and financial variables already prior to the great financial crisis. So he has been on top of what is driving macroeconomics already. He has been on top of the relevant macroeconomic research for already a long time. And the last year or so, during the strategy review, it's only been confirmed that Roberto is a key staff member at the ECB, and his rigorous and always relevant analyses shape discussions and decisions by the Governing Council, and that's not been any different during this strategy review. So we are very lucky to have him with us to give a talk about the book he recently wrote on 20 years of ECB monetary policy. So without further ado, I can give the floor to Roberto. As usual, you can send questions in the chat, and Roberto will take up these questions after his presentation, which will take something like 30 to 40 minutes. So that leaves us some time for questions. Roberto, the floor is yours.
Thank you, Jeff, for the nice words. Been very generous in your introduction. As you said, this is joint work with some of my colleagues here in the policy department. They are listed in the front page of a book that you see in the slide. So why a book on the ECB monetary policy? Well, it started because we wanted to document the history of ECB over the previous 20 years, on the occasion of the 20th anniversary of the ECB. But then we started and it grew and became longer and longer, and at the end was a book. The aim was to provide a perspective of the ECB staff into the decisions that over these 20 years have been taken. I think they often only part, say the top of the iceberg of the ECB staff contributions. They go into supporting policy decisions, so only say the top is visible to the outside. And we thought that this occasion of the 20 years could be the opportunity to bring also to the outside some of this work in a more coherent forms. And as Jeff said, some of this work was also over time then he made it into academic publications or economic bulletin articles, but then to give really an overview consistent over these 2 decades. And we also offer some new analysis, especially on the impact of non-standard measures. And at the end, the book became also an input one of the inputs into the reflections on the ECB strategy review that took place over the last 1.5 years, and it was concluded last July. And I will come back to this at the end of my talk. So let me say that the views expressed in the presentation, in the book, are the author's views. They do not necessarily reflect the views of the ECB and the Eurosystem. So today, I will focus on two topics that are covered in the book. They also correspond to two chapters that you see here in red. So the first topic is how the ECB definition of price stability, and more generally the price stability framework adopted by the ECB in 2003 have also contributed to shape the decisions and the expectations by markets about ECB policy. And the second topic is about the impact of the ECB's non-standard measures taken over the last 5 years or so. So let's start from really the beginning. So in 1998, so just before the single currency started in 98, but just before that, the Governing Council already thought that it was very important to guide inflation expectations and more generally expectations about the conduct of the ECB policy. So it adopted a price stability framework that was sort of quite peculiar at the time. So it had a ceiling of 2%, and it was a range of positive values. So let's say going from 0 or slightly above 0 to 2%. You see in the chart this gray sort of zone between 0 and 2, and this will accompany us also in the following presentation and see the implications and how it has evolved. So the historical background, let's say, of this definition of price stability is, of course, that in the previous decades, inflation was very high, especially in some countries, double digits. So then the Governing Council wanted to lock in the low inflation that prevailed at the start of a single currency. And you see here no inflation coming down, but of course in the 80s and 70s inflation was much higher. Sorry, I see that there is some. Yeah, now it works. So in 2003, there was an evaluation of the ECB strategy. And again, the historical background is that there was a long period of Japan being in deflation. And there was also some concerns also in other countries following the bust of the dot-com bubble in the early 2000s of possible disinflation and deflation risks. So the Governing Council decided to supplement the definition of price stability with something new. And this was an aim, was called an aim of below but close to 2%. They're represented here with the diamond. So this had to create a safety margin above 0. So it was sufficiently above 0 to give also space to provide accommodation and to avoid some shocks might push down inflation to 0 or below 0. So this was like an important innovation that was felt to strike a bit of a balance to lock in a low inflation, but like not too low. So that's very close to 2%. However, of course, this double formulation, so with a ceiling at 2%, and then having an aim just below 2%, it means that over time it's very likely that inflation will be often above 2%, just because the below 2% is very close to the ceiling of the definition of price stability. And this might imply that there is some true or perceived asymmetry in the policy response, because if the aim is so close to the ceiling, and to avoid going above the ceiling, policy might be more concerned about upside deviation of inflation rather than downside deviation of inflation. And doesn't seem to work.
Roberto, uw geluid is staat. Your sound is off.
Hello?
Yeah, okay.
Can you hear me?
Yeah, we can hear you.
Okay, sorry about this. So then it happens that in the first decade that we call the first regime, largely coinciding with, let's say, from 1999 to 2008, so just before the great financial crisis, it happened that the euro area was hit mainly by supply-side shocks of different kinds, all inflationary shocks. Here, to exemplify, I show the energy component, so very much driven by oil price. And if you see the scale, so the scale of this red line is on the right-hand side. You see, I mean, very large cost push shocks. And this was, of course, driving also headline inflation. There is the solid blue line at the ceiling and a bit above the ceiling. Then the framework acted as it was supposed to be, so as a stabilizing mechanism. So then it creates expectations of a very strong policy reaction. And even when the policy rate was cut, and we see on the chart on the left-hand side, we see the red line. So even when the policy rate was cut, there were always expectations that soon after the policy rate would have been increased. And we see with the blue line, there is the forward rate. So expectations were always for an increase soon after of interest rates. And then, of course, this was exerting a tightening impact throughout the financial conditions of the general economy. And this allowed monetary policy, so the actual interest rates, to be rather gradual and patient in their movements, because so the markets were doing the central bank job of controlling inflation via some tightening bias. But how did it work in practice? So in practice, given that often the interest rates were not changed much, and for example, if you compare the changes in interest rates in the euro area and the US had twice as much width of the changes. So we see this in the right-hand side chart. So the way it worked was largely via sort of open mouth operations, so to speak, because the language was very often a hawkish language referring to risks of inflation, second round effects, inflation tendencies, and readiness to act. So this was something that triggered also the reaction in expectations for future policy actions. The stabilizing mechanism was very much also visible as an end result in the strong anchoring of inflation expectations. We see in this chart, this purple line is long-term inflation expectations, so 5 years in 5 years compensation. And then, of course, it also includes a premium. So what we do is also to clean the measure of the inflation premium, and we get to the orange line. And we see that it was strongly sort of anchored to where it was supposed to be. So just below 2%. So it starts sort of later because it's available only later in the sample. We don't have this type of data for the first part of the sample. However, when we look also at long-term inflation expectation from surveys, we see that is available also from earlier on. We see the same picture of very strong anchoring of inflation expectations. However, if headline inflation has to remain at about 2%, and so it should not, and it should be really avoided that it goes above 2%, and there are so many inflationary shocks, and this is the first sort of decade, so up to 2008, it means, and this is to some extent also some just algebra, means the core inflation that we can define as the domestically generated inflationary pressure, and is shown here with a dashed blue line, has to go down. And actually, we see that before 2008, when headline, so the solid line is going above 2%, core tends to go more south. So there is this kind of negative correlation. And this is not just core. We see also other measures of underlying inflation. We see this green thick line. It includes many different measures of underlying inflation because, of course, there is also uncertainty, model uncertainty, statistical uncertainty on how underlying inflation should be measured, but we see that they all display the same pattern. So they tend to go down when headline go up. But then in practice, how does it work? The core goes down when headline goes up. So an important adjustment mechanism was the appreciation of the euro. And you see in the light green lines on the upper part, this is the exchange rate of the US dollar vis-a-vis the euro. So when you see it goes up, this is an appreciation. And you see that over the period that we are looking at, so the first decade, there were very strong appreciation of the euro when inflation was going up. And the reason is because there was much more monetary contraction in the euro area compared to the US. And this was an important mechanism. We also conduct some new econometric analysis to see whether there is support for this idea that the first decade was very specific in terms of shocks and in terms of reaction. Then I will move in a minute to the second decade where we see something different. So the analysis seems to support our narrative that I just presented. And here is documented by these charts. What we see here is, so there is a shock putting upward pressure on inflation. Then the first panel shows the expectations for the policy rate in the next year. And we see that it goes up. So markets were expecting a contraction of ECB policy. We see in the middle panel, this is the 10-year inflation compensation, so covering the very long horizon, and it moves very little if you look also at the scale compared to the change in the short-term interest rate. And then in the last panel, you see core, and you see that it goes down. So there is an upward shock inflation, headline goes up, inflation expectation goes up, but core goes down. And there is an expectation that policy will be contraction. So this is what so the narrative that I was describing before. that is also confirmed by this analysis. Then a second regime comes, and this largely coincides with the crisis period. So first, starting 2008 with the global financial crisis, and then something specific to the euro area, there is the sovereign debt crisis. In this period, shocks were very different. So I was saying in the first decade, it was mainly upward shocks to inflation, mainly cost push shocks, oil price, and so on. And in this second decade, we have downward shocks and also different kinds, mainly disinflationary, deflationary shocks, low aggregate demand, financial shocks, deleveraging caused by the financial crisis, and then the sovereign debt crisis. So what we see is also that faced with this situation, the price stability framework of the ECB, to recall, has this range between 0 and 2, and an aim just below 2, was probably less suited to provide guidance to markets and the public at large about inflation expectations and future ECB policy. Why? Well, because the ceiling works very well when faced with inflationary shocks. But when there are disinflationary, deflationary shocks, the ceiling doesn't bind. And then we are sort of in the middle of the definition of price stability. There is a lack of a clear floor. The only clear floor is 0. And in between 2 and 0, it was probably not always clear whether the ECB was aiming at 1.9, 1.7, 1.5. Somebody was even expecting 1. And also then it means in terms of policy reaction, how strong policy reaction could be. Then rates were cut because also of the low inflation and recession in the euro area. And then at some point also the lower bound, the concerns about the lower bound started to become real. The lower bound on nominal interest rate that at the time was mainly thought to be 0 was felt as being a hard constraint. So at that point, monetary policy cannot do much to contrast disinflation and recession. So all this ended up in also providing less guidance to inflation. Core inflation moved to the middle of the range. We see that stabilized at about 1%, so very low compared to the about 1.8 and 9 prior to the financial crisis, so the previous decade. And now here, some econometric analysis of the kind I showed before, but this is done with allowing for 2 regimes, and these are mainly coinciding with the 2 decades. And we see now in the bottom part of the slide, the second regime. So here, as I said, shocks are of different nature. So now are disinflationary shocks. Before we had upward pressure, now we have downward pressure of inflation. And we see that the interest rate in the first panel was expected to react very mildly. It's hardly significant. Whereas inflation expectations, again, here is the 10-year inflation compensation, moved down significantly. And we see the core is moving in the same direction as also inflation expectations. So now they move together, both down, whereas in the previous decade, we see in the previous line above, that when inflation expectations were up, then core was down, so negative correlation. So now core is drifting down with headline, and we have this unfavorable situation where it's more difficult to anchor inflation expectations. So by 2014, these inflationary risks were prevailing. And here, just to give an idea of the situation, this chart is showing an inflation dashboard. With this, we mean a a set of measures and measures of inflationary pressures that one could think about. We didn't want to select one to say, well, but perhaps if you take another one, you get a different answer. So it goes from just headline inflation, core inflation expectation, different maturities, but also developments in wages, so nominal wages. And we see in the gray boxes with the lines, these are the historical realizations. So the very bottom is the lowest ever seen in the euro area. And we see that by 2014, the readings of these indicators, that is represented by this red line, were really at the bottom. So all indicators were signaling that inflation pressures were as low as ever. And at that point, really, deflationary risks became a concern. And again, we were in a situation in which the interest rate was at the zero lower bound. So to regain control of inflation expectations and control of inflation process, the Governing Council decided to take a very strong policy response. And this featured several measures taken more or less at the same time, with a view that they could not only add up to each other, but really reinforcing each other, so that their combination is just more than the linear sum. And there were four measures. So the first one was the adoption of negative interest rate. So the interest rate will move down below zero in steps of 10 basis points, also because it was new territory, to see how the economy and financial sector would react. The aim was to lower the lower bound that, as at the time and in many jurisdictions, was zero, to move it below. So then it could shift down interest rates at short, but hopefully at all maturities, and this is what actually happened, and I will show in a minute. The second measure was purchases of private and public sector financial assets. And here the aim was to push down especially the medium and long-term interest rates. The third measure was forward guidance to guide expectations regarding the ECB purchases and the ECB policy rates in the future, with the idea here that especially medium long-term rates are also a convolution of the expected rates. So then the more guidance can be provided on the path of the policy rate and the path of purchases, and this will affect also the medium and long-term rates of today. And these rates are also the ones that then feed through in the financial conditions, for example, faced when businesses borrow, households take a mortgage. And the fourth measure were targeted long-term refinancing operations. And here the aim was to compress the cost faced by banks to generate loans. And the ultimate aim was, of course, then also to make sure that banks could pass through these lower rates into lower lending rates to businesses and households, and to increase the volume of loans. So in the book, we present also some analysis regarding the impact of these measures. So what I show here is by year, seeing the horizontal axis, and by maturity of interest rate, 2, 5, 10 year, and here is the sovereign yield aggregated across euro countries using GDP weights. So some observations. So we see that all measures, and each measure is depicted with different color. So all measures contributed to lower interest rates. And we see in green that also negative interest rates affected, not just short-term maturity, but also long-term maturities by more or less the same amount. So it was more or less like a level shift. We see also in red the forward guidance providing important contribution, and the largest contribution, also because of the size of the purchases, was provided by asset purchases in the light blue bars. And here, as expected, the impact is sort of stronger in medium and especially long maturities. And we see there has been also a build-up over the years, also because these measures were recalibrated in face of new shocks, new recessionary and disinflationary shocks. So this support provided by policy measures was not just on the financial system and interest rates. I don't show here the impact of the long-term refinancing operations because it didn't act on the market interest rates, but on the lending rates. And in the book, we document that there has been a very large decline in lending rates, and our econometric analysis suggests that it was to a large extent due to the composition of measures and very much also to the long-term targeted refinancing operations. This policy accommodation was also very important in supporting the macro economy. And we see here on the left GDP growth, on the right inflation. There was also very strong support of unemployment. So unemployment rate went down significantly because of the measures. The chart is constructed more or less as the previous one, so is by year and is decomposed by policy measures. So we see that with the solid blue line is where GDP growth was actually in the data, and in the dashed line where it would have been without the policy measures. And we see that in 17, 18, especially, so in each of the 2 years, there is a 1 full percentage point support of the measures to GDP growth, and this is also translated into lower unemployment. Then we see on the right-hand side the support of inflation. So also there was support, and he allowed to overcome the deflationary risks and to re-anchor inflation expectations that, as I said, was showing clear risks and already materializing risk of disanchoring towards the lower level. Now, so much for the book. I would like now to say a few words about the ECB new monetary policy strategy. So this exercise was carried out over the last 1.5 years. It was a joint effort of the whole Euro system. So was the ECB staff with staff of all national central banks. So it was a very, very close cooperation with National Bank of Belgium colleagues. And so staff provided inputs to the deliberations, reflections of the Governing Council. All this work has been brought to, say, the public. So in September, the ECB published almost 20 occasional papers, each on a different sort of topic covered by the review of the strategy. So they're available online on the ECB website, and for so interested readers, they provide all the background analysis that supported the reflections of the Governing Council. In last July, the Governing Council concluded these reflections, and it published a monetary policy strategy statement with the decisions that have been taken. So here there is sort of an outline of the topics covered by the strategy statement. as you can see, it was a very comprehensive review, touching upon many topics. Today, I would like to focus on sort of two broad issues that are related to the topics I covered before in my talk. So the first set of topics, we might call it the price stability framework, and it covers point 4, 5, and 6 of the statement. And the second sort of topic I would like to say something about is about the monetary policy instruments. So, as probably some of you are familiar, but let me sort of describe the decisions regarding these two points, and the price stability framework and monetary policy instruments. And so regarding the policy framework, it was decided that price stability is best maintained by aiming for 2% symmetric inflation target over the medium term. So the medium term orientation was preserved. I didn't say much, but was very important also to avoid the real economy and inflation could be too much affected by the inflationary shocks that have been hit the euro area in the first decade. This was confirmed. The definition of price stability I mentioned before, this range between 0 and 2, and the aim just below 2, was replaced with a new 2% symmetric inflation target. So this removes any possible ambiguity that there might be existed regarding the symmetry of the previous price stability framework adopted by the ECB in 1998 and 2003. So there is unambiguous. Now it's 2% symmetric. And the value of 2% provides a safety margin above 0 to face disinflationary shocks. At the same time, it is still low enough to minimize the costs of high inflation. And in practice, what it means being symmetric. So the Council has clarified that symmetric means that it does not tolerate upward deviation, downward deviations over the medium term. Over the medium term is important because monetary policy cannot control inflation over the short term. There are transmission lags, with uncertainty, and also because the flexible medium term allows the central bank to take into account other considerations like employment, financial stability concerns. The Governing Council has also made clear explicitly that there is a need to take into account the implications of the effective lower bound on nominal interest rates. And here it has stated that when the economy is operating close to the lower bound on nominal interest rates, this requires an especially forceful or persistent monetary policy action to avoid the negative deviation of inflation from 2% becomes entrenched in inflation expectations, especially long-term inflation expectations. And it has stated that this might also imply a transitory period in which inflation is moderately above target. As regards the sort of second topic I touch upon, so the policy instruments, and this is what the Governing Council has decided, the new strategy. So first, it has decided that the short-term policy rates remain the main policy instruments of ECB, so it's a confirmation compared to the past. And it has also stated that in recognition of the effective lower bound on the policy rate, the Governing Council will continue to employ the measures that have been adopted over the last few years that have been proven to be effective, like forward guidance, asset purchases long-term refinancing operations, and the decision will be taken by the Council as appropriate. So let me conclude by saying that, so now what I said in the first part of my talk and now regarding the ECB new strategy. So in the first part of my talk, I tried to show that the framework, the price stability framework, as it was designed in 1998 to 2003, was a very powerful system and framework to face upward shocks to inflation, and of the kind that turned out to prevail in the first decade. However, it provided less guidance on how to react and how to guide expectations and markets themselves, how to think about the ECB strategy when it comes to disinflationary and deflationary shocks. So the new strategy has now adopted a 2% symmetric, very clear target with downside, upside deviation of concern to the Governing Council over medium term. And the new strategy has also made clear that the lower bound may be a constraint on the policy space and has been adopted also and made clear a way to address this problem. So the new strategy seems to be more robust and fit for facing a changing and fast-changing world as the one we might face, both regarding upside and downside inflationary shocks. So I can stop here, and I'm very happy to take questions on what I said of more generally on the strategy and the book. Thank you.
Thank you, Roberto, for a very comprehensive and interesting talk. We have a few questions coming in, so I'll try to go through them. Maybe a first one regarding the strategy review. So the ECB announced that it would take the cost of owner-occupied housing into consideration when assessing inflationary pressures. And someone has two questions in this regard. First, does it include the evolution of real estate prices themselves, or is it limited to the cost of owning a property? And secondly, in terms of quantification, what would be the impact?
So in the book, we don't touch upon it, and so this was I didn't say anything when I present some highlights of the strategy review. So in 1998 and 2003, the Governing Council decided that HICP, so the Harmonized Index of Prices, is the best indicator available in the euro area and in each individual country for monetary policy purposes. So this review of the strategy has confirmed that this index is the best available. At the same time, the Governing Council has highlighted, as the question also was suggesting, that is an incomplete measure because it does not include something that is very important from the point of view of households in their index, their expenses. So then something that one might want to include in the index, but is currently not. However, this is so the index of prices is not done by the ECB. I mean, before and also now, it's not constructed by the ECB. It's constructed by Eurostat, also to be independent. And so it's something that the Governing Council has sort of encouraged and has adopted a roadmap for the inclusion of owner-occupied housing in HICP. This is a multi-year project. And in the meanwhile, since the Governing Council don't want just to seat and weight. So it was decided to monitor the implications of including the owner-occupied sort of component of inflation. There are different sort of ways of measuring, and so the concern when it comes to any kind of asset prices is the monetary policy should not aim to stabilize asset prices per se, and this is the same for owner-occupied housing. For this reason, the idea is to disentangle what is the pure appreciation or depreciation of the asset itself with the services that is providing. The ECB also from now on regularly, the Governing Council will discuss it, and there will be references. Also the President has made references, as you have seen in some speeches, and I think also in the Economic Bulletin article, and present also a range of values. Currently, if this were included, the inflation would be higher than the actual reading of inflation.
Okay, thank you. Then there is a question also related to the appropriateness of the 2% inflation target, and it's argued that you need a buffer against deflationary shocks. But here the person asks whether the techniques to measure inflation in the 2000s have not become much better, and in that respect, is it still needed to have an inflation target of 2%, because the confidence interval that inflation is correctly measured is much smaller now, and so that argues against having this buffer and probably having a lower inflation.
Yeah. No, this I think is a very very good question. Because I didn't have the opportunity to go into the details. So when in 1998 it was decided to have this range of below 2% but above 0, it was said that it's difficult to quantify the floor of the range, if it should be really 0 or preferably a bit above 0, but difficult to say where. And the reason that was mentioned is because of a measurement bias, the so-called measurement bias in inflation. And back then there was a Poskin report in the US and showing that there is a large positive measurement bias. Then the euro area had the sort of a luxury of being a new area. So then the new index created by Eurostat, the HSCP, was a much better index, also different kind. So the measurement bias was for sure lower than the US, and it was difficult to say how much. So this was the reason. However, in 2003, it was when it was decided to have a name close to 2%, and then now saying symmetric inflation of 2%. The main reasons are not the measurement bias. The main reasons are to leave a buffer above 0 to face deflationary risks. And in practice, this means that let's take a longer term perspective. Something that I didn't mention, that over the last decades, and especially over the last decade, the equilibrium real interest rate has declined for 2 or even more to very low values. So there is uncertainty, probably 0, probably negative. Current estimates say there is negative. But let's suppose even there is slightly positive. So this is the real interest rate of, say, slightly above 0. If we have, let's say, an inflation target, let's say, of 1%, then the nominal interest rate is slightly above 1%. Then, so these are the very long run, sometimes called the steady state. Then there are shocks, upside, downside. If we start with a nominal policy rate at just above 2, then in face of disinflationary recessionary shocks, there are about 200 basis points to cut before going to the zero lower bound or going negative. And this is not much. And facing previous sort of recessions, also in the euro area was used something like 400 basis points, in the US 500 plus. So the policy space is not a lot. So this is why a safety margin of inflation. If inflation is 2%, then there is a bit more space than if it is 1%. Of course, if it is 3%, there is even more space. But then is also a trade-off between having inflation sufficiently low that it does not so disturb the decisions of households and firms, and having a too high inflation that then becomes distorted because inflation is also a cost. And so then the 2% strikes a kind of balance between the opposites. This buffer of 2%, because the target is 2%, offers also a buffer to take into account other issues. One is the measurement bias, another one is nominal rigidities, another one is downward nominal wave rigidities that could create very high unemployment.
Thank you. Two questions related to the risk of higher inflation. The first one is the fact that with the transition towards a green economy or towards a climate neutral economy, is there not a risk that we are back in the first decade in the sense of the ECB with mainly upward inflationary pressures that are pushing inflation up, and what would be its implications? And the second person asks more generally, there is a lot of money being injected into the economy or into the banking system over the last few years, and what is the risk of hyperinflation and what are the tools to deal with that risk?
So regarding the first question, perhaps let me start with the second question that perhaps requires a bit long answer. So there is a lot of liquidity in the system. This is true. This liquidity has been created partly via the demand for long-term central bank liquidity by banks via the long-term refinancing operations. Part of it, and actually a larger part of it, has been created via purchases of private and public sector financial assets by the Eurosystem. So this liquidity sits in the books of banks and ultimately in the Eurosystem. And so far, there has not been a sign that this liquidity is sort of fueling large inflation. So we see now large spikes in inflation, largely driven by something else. So related to the pandemic, global shortages, or some statistical effects, base effects, reopening of the economy. In case the liquidity were to create in itself pressure, then of course the Eurosystem has all the tools to drain liquidity. But first of all, by the different instruments it has and it has used, they can be used in reverse. So there is no concern. And in any case, as long as inflation expectations remain well anchored, the wage setting behavior remains not exuberant, then it is very difficult, almost impossible to generate the runaway inflation. It's possible to generate temporary inflation of the kind that we are seeing now. The first question, sorry, I forgot another question. Can you remind me?
On the impact of greening the economy on inflation and whether it will be back to the 2000s.
So this is something that the Governing Council has decided has been something very important to, first of all, understand better and to take actions. So it has announced a roadmap to address and to take account these issues. So one part of this is to improve, strengthen our analytical and model-based capacity to better understand the phenomenon and the implications for monetary policy. And another part, very important part, is more related to operational issues. I mean, the collateral, the corporate bond purchases, and so on. Disclosure, risk analysis. As regards the inflationary impact, it's still not clear whether on net there will be more inflationary or disinflationary effects. The reason is that for sure there are some, say, first order effects of the supply type, so upward pressure. But at the same time, there might be also a countervailing effect given by the fact that this might require also kind of thermotrade shocks, also some curtailment of the income. And then, of course, this might bring also new technologies with changing relative prices. So it's still difficult to say exactly how it will work out. There is, for the interested readers, there is also one of these occasional papers that I mentioned is exactly on climate change. So some more can be found there about what we know and what we don't know.
Okay. Maybe there was an issue, so I just quickly an issue with the sound for Roberto. Just to repeat the final sentences, he said that there is also a very elaborate ECB occasional paper, I guess, that summarizes all the work that's been done in terms of climate change and its implications for monetary policy. Maybe one final question to conclude. It's a question that goes in the other direction. What if economic growth would decline significantly in the future? And given the set of instruments that have already been deployed now, how far can asset purchases and targeted lending to banks be extended given the balance sheets of the central banks? And perhaps related to that, a question, is there any evidence in your book or in the analysis that's been done in the context of the strategy review that monetary policy is more effective in stopping high inflation than in stimulating low inflation? And so related to this question, also lower economic growth.
So we don't find in the book, but also in other analysis, we don't find evidence of this say asymmetric response, where the impact is stronger on one side than the other side. What both in general for financial conditions and more generally the macroeconomy. What is true is that some of the measures have also the impact of contrasting large, the dysfunctioning of markets. This, for example, was with the pandemic asset purchases over the last year and a half. And so it's true that when there is dysfunctioning, fragmentation in financial markets, some of the measures may have a stronger effect, but this is also the times in which like interest rates, market interest rates go up. So there will be less of a concern that they are already very low because they went up. And so then they can be brought down to lower levels. regarding the, let's say, the policy space that is available and remains available. So the Governing Council has clarified that it's not like short of instruments, and I think it has shown over the last several years that has been always acted also in innovative manners when needs be. And the same was shown with the pandemic, where new measures were created, some existing measures were recalibrated in new ways that turned out to be very effective. So I would not see this concern.
Okay, maybe there's one question that just came in, and it's maybe an interesting one. How did or does the ECB consider the impact of aging of the population on inflation and real interest rates? And reference is being made in this context to Japan, where aging is happening sooner, or has been happening sooner than it has been the case, or that it is the case in the euro area. And there you see clear deflationary pressures. Is that something that has been taken up in the review, and what are its implications?
So it was, so the analysis was more general on the drivers of the equilibrium real interest rate. And one factor is, of course, productivity and other things, but one is also population and aging in particular. Also here, there is an occasional paper documenting some of this. It was not, let's say, a major topic of discussion, and because also it's a very sort of long-term trend, and it's also not as probably the person asking this question is also somewhat also controversial in the literature, the direction in which it goes. So I'm sure that I mean, there will be more analysis. I think also there is an economic bulletin article on this, both for bigger interest rate, but also for the pension systems. So I think we'll see more on this also in the future.
Okay, thank you, Roberto. I think we can close the webinar here. Thanks again for being here. That leaves me to say that the next NBB webinar will take place on Friday, the 17th of December, before the Christmas holidays. And during that webinar, you will get an update on the latest economic projections that have been produced by the NBB in the context of projections that are made for the euro area as a whole. So Friday, I think around lunchtime, there will be a new NBB webinar with Geert Langenus and the Governor Pierre Wunsch. Thanks again for being here, and enjoy the rest of the day.